Hello friends, good day to you all. My name is T.D.Prasad and I am a fellow of the Insurance Institute of India and I am engaged in training insurance professionals. I welcome you all on behalf of Vizza Insurance Services for today's program on basics of risk management. This program on basics of risk management is part of broker compulsory part of broker qualified person examination conducted by National Insurance Academy, Pune. When we say risk, generally by and large we use this word risk very frequently in our daily life. Everybody uses, but when it comes to understanding what is risk with reference to insurance domain, we need to understand two important things regarding risk, which we are going to see now. First, let's understand what is risk. A risk is basically a psychological phenomena. It's perception, because when we say risk, we are talking about an event that has not happened, an event that is expected to happen in the future. So it's basically a psychological phenomena, an understanding that happens in our perception. So before actually understanding risk, let's see how our knowledge about an event will lead us to various levels of understanding of the event. The first step is ignorance. But when the question comes, what is ignorance? We have to answer one question, an important question. What is the difference between a man, a human being, and an animal that made the human being so successful compared to all other animals in this world? What made the human being take over this planet and reach moon, succeeding over all other animals? The people by and large say it is because of intelligence, but that is not the basic difference, because animals also do have intelligence of various degree, right? Then what is the basic difference that makes a man so successful compared to other animals? The simple difference is an animal knows what it knows, whereas a human being knows what he doesn't know. This is the fundamental difference. We know what we don't know. When we know what we don't know, we start searching for solutions. Once we start searching for solutions, over a period of time, it may take years, it may take generations, but we will get the answer. Once we get the answer, we advance in our thinking and in our abilities, our civilization. This is how man has progressed, by knowing what he doesn't know. Whereas animals, they don't know what they don't know. Animals know that fire hurts. Human being also knows fire hurts. But animals' understanding stops there. But whereas a human being thinks, what is this fire? He knows that he doesn't know what the fire is. He knows he doesn't know how to make fire. He knows he doesn't know what fire can be used for. All these things he knows that he doesn't know. This is the basic difference. Once he understands that he doesn't know these things, he'll start searching for solutions. He'll get the solutions. Right? Now, the question is, when we don't know what we don't know, that is ignorance. We need not know everything, but basically we should know what we don't know. So when we don't know anything about a future event, then it is our ignorance. There is no insurance or anything pertaining to that, because we just don't know what event is going to happen in the future. We have no idea. So that is ignorance, right? Now, the next stage is we get some understanding of the event that is going to happen in the future. We know some event is going to happen in the future. Our understanding of the event has improved to that extent, right? Now, we only know what event is likely to happen. We do not know the chances of that event happening, and we do not know the magnitude of loss that the event can cause. We do not know these two things. So we are uncertain about the event. We are uncertain because we don't know the chances of the event happening, whether it is 10% chance, 50% chance, 90% chance, 100%, we don't know. And what is the magnitude of loss? It can cause heavy loss, medium loss, low loss. And if loss is caused, what is the quantum of loss? We don't know. We have no information about the event. What we know is only it can happen. So we are uncertain about the event. From ignorance, we have moved to the stage of uncertainty, right? So from the uncertainty, we have some more information about the event. Like now we know the odds of the event happening. So what are the odds of a person in Chennai dying in a two-wheeler accident? We know the odds because in Chennai, every year 500 to 600 people die in two-wheeler accidents, say for a population of 50 lakhs. These are the odds, 500 out of 50 lakhs. These are the odds. We know the odds. We know the event. Odds of the event we know. Do we know what is the loss? Yes, we know. The person can die. The maximum possible loss is the person can die in a two-wheeler accident. Right? So this is the risk. When we know about the event, the probability of happening the event and the possible maximum loss that can happen because of the event, then we call it a risk. And at this stage, this risk can be covered by insurance. Suppose we have more information about this risk, about this event. Say we know for certain when this event is going to happen, how this event is going to happen. We are certain. Like a person having a third-degree cancer, the doctors declare he is going to live only for another 30 days, 1 month. It is certain that he is going to die in another 30 days. We are certain. We are certain about the event, right? Then we are certain about the loss. And because of the event, the person is going to die. The loss will be a total loss. It is death. Now, our knowledge about the event has gone to the level of certainty. Once it is certain, it cannot be insured. Because a person who is going to die in 30 days, we cannot give him life insurance policy at that time. A person who is already admitted to the hospital and then going to die in 30 days, we cannot give him health insurance policy. Certainty is not insurable. Uncertainty is not insurable because we don't know what will be the loss. What are the odds of loss taking place? So uncertainty is not insurable. Of course, ignorance, there is no question of insurance because we don't know what to insure. So uncertainty cannot be insured. Certainty cannot be insured. Only the risk that lies between the certainty and uncertainty can be insured. So we have seen for an event to be called as a risk, for an event to be classified as a risk, it has to meet two conditions. Number one, we should know the odds of the event happening. Number one. Number two, we should know the possible loss that the event can cause in financial terms. When we know these two things, we say the event is a risk. But for understanding risk, okay, these two are the basic conditions that define the risk. But with reference to insurance, in insurance domain, understanding risk requires an understanding of three parameters. Because of course, when we are saying that one main condition of risk is financial loss, there must be an asset before we talk about loss. Then what is an asset? Asset is something that has got economic value to the owner and loss of which will cause economic loss to the owner. That's an asset. If there is no economic loss, it is not an asset. Right? Then the second thing, this is the first thing, asset is first thing. The second thing is peril. Peril is a threat of loss to the asset. An event, peril is an event that causes loss. Right? So it is threat to the asset. This is second condition. There must be peril. The third condition is vulnerability of the asset to the loss. Because all perils will not cause loss to the asset. So the asset should be vulnerable to loss. Let's see, if we take one or two examples, we'll understand very easily the relationship between these three. Now consider risk as a triangle. This triangle, in one corner is the asset, in the other corner you have threat, and the third corner you have vulnerability. When all these three things coexist, then you will have the risk. Right? Now let's see one example. Suppose you have two houses. One house on Chennai ECR and one house in Ooty. These are your assets, two assets. The loss of these assets will cause you economic loss. There is no doubt about that. So, they are assets. Now, peril. Let's take the peril, the threat of tsunami. When we talk about this tsunami, your house asset in Chennai ECR is vulnerable to loss, whereas your asset, your house in Ooty is not vulnerable to loss because of the tsunami. Right? So the asset in Ooty is not vulnerable to tsunami loss. It is not possible to have tsunami in Ooty. It is not vulnerable. There is no threat. You have an asset. At the same time, the house at ECR, Chennai, is vulnerable to tsunami threat. A peril of flood. Suppose there is a multi-storied building, 2 floors, 3 floors. You are living in second floor and your tenant is living in ground floor. Okay. Now the flood is a threat, it's a peril. Now vulnerability question comes when it comes. The people living in ground floor are more vulnerable compared to people living in second floor for the flood. So it changes. The same peril, the vulnerability of the asset keeps changing. So coming back to your house in Ooty, let's consider the peril of landslide. When we consider the threat of landslide as a peril, the house property in Ooty is vulnerable while your property in Chennai ECR is not vulnerable to landslide. So the risk perception varies based on the threat and the vulnerability of the asset to the loss. So far what we have seen is definition of risk. When an event is expected to happen and when we know the odds of the event happening and when we know the maximum possible loss that the event can cause, then we call it a risk. This is what we have seen. And now we move on to managing the risk. When we say risk management, what should be our objective? It is simple. We have 2 problems pertaining to risk. One is odds of the event happening, the other is the possible maximum loss. These 2 are the parameters that define the risk. So when we are trying to do risk management, what we do, we are managing these 2 things. Then what should be our objective of risk management? The principal objective of our risk management should be to reduce the probability of the event happening. That's number 1. And number 2, to reduce the possible maximum loss that the event can cause. All our efforts in risk management are directed towards these 2 things. So when we are doing risk management, we will have 3 steps in risk management, 3 important steps, overall steps through which we do the risk management. What are the steps? Number 1, risk identification. Number 2, risk measurement. Number 3, risk control. These 3 are the basic steps through which risk management is done. So first, risk identification, measurement, risk measurement, these 2 steps are basically a kind of theoretical steps. That is, you are not actually doing any action. You are trying to identify the risk through various means and then you are trying to measure the risk through various means. Right? The first thing is, let us see risk identification. For identifying risk, we have to understand the classification of risks, because there are umpteen number of risks. They have to be classified in a proper manner so that we understand the various issues pertaining to that risk. The classification is done based on various parameters, like for example, based on extent of damage, right? Based on extent of damage, the risks are classified as critical or catastrophic risk. When the damage is extensive, it is called a catastrophic risk. For example, risk because of earthquake. Loss because of earthquake is extensive. Like for example, Latur earthquake. So many people have died during the earthquake. Right? It's a catastrophic loss. Tsunami. It's a catastrophic loss. So generally in insurance parlance, it is called cat loss, in short. So the first classification is catastrophic loss based on the extent of damage. When the damage is extensive, it is called catastrophic loss. The second classification is based on measurability in money terms. When the loss is measured, sometimes it is possible to measure it in terms of money and sometimes it is not possible. Death of a person, a fire accident, a flood accident, loss to property, all these things can be measured in financial terms. So these are called financial risks. And there are certain things that cannot be measured in financial terms, like loss of reputation, loss of goodwill. These cannot be measured in financial terms. So they are called non-financial risks. This is second classification. The third classification is based on the impact of socio-economic and political conditions on the risk. Right? When these are affecting the risks, they are called dynamic risk or static risk. Let's take the case of dynamic risk. Let's say, for example, you have a garment factory. Right? So you are in the business of making fashion garments. So this year particular fashion has sold so many units. So you plan to sell the same thing next holiday season, same garments, you produce so many quantities and then stock. But when the next season comes, suddenly you find the fashion has changed because of certain social conditions. People have adopted new fashion. Then what will happen to all the product you made for that season? It's a loss. And this is because of social condition, change in social condition, right? You have got certain export orders. You have transported all the materials to the port. You are ready to export. Suddenly government bans the export of that particular material, like what has happened recently on wheat. What happens? Because of some political decision, you have suffered loss. So this is dynamic loss, right? So like this, socio-economic conditions on which you have no control, they keep changing the loss pertaining to the risk. So they are all dynamic risks. On the other side, what you have is static risk. They are not concerned with the fire accident in the factory. They are not concerned about what is happening outside the factory, socio-economic, political conditions. They have nothing to do. A road accident. And none of these things have any relevance to the accident. So these things become static risks. Right? Now, what is happening when we are classifying these risks, we will also see whether these risks can be insured or not. When we spoke of catastrophic risk, the risk is insurable because they are all because of act of God perils, like your earthquake, cyclone, tsunami, all these things, flood, act of God perils, and they become insurable. When you come to financial and non-financial risks, financial risks can be insured because the loss can be measured in financial terms. Non-financial risks cannot be, like goodwill loss, reputation loss, cannot be insured. When we talk of dynamic and static risks, dynamic risks are not insurable. They cannot be insured. Whereas static risks can be insured. This one needs to understand. Now coming to the fourth classification, it is based on who controls the risk. The classification is done as pure risks and speculative risks. For understanding pure risk, first let us see what is a speculative risk. You invest in stock market. When you invest in stock market, actually you are taking a risk. Now what is happening for the loss? Stock market, you may make a lot of money, you may gain actually in stock market, or you may lose a lot of money. Both things can happen. This is called speculative risk. In a speculative risk, there is a possibility of gain and possibility of loss. And when such risks are taken, they are called speculative risks. Speculative risks are not insurable. They cannot be insured. On the other side, what you have is pure risk. That is, in a pure risk, you only have loss. There is no possibility of gain. When you meet with an accident, you only lose. There is nothing to gain in an accident. When there is a fire accident, you only stand to lose, nothing to gain. In flood, you only stand to lose, nothing to gain. So, a pure risk is that risk where you only lose in financial terms, and there cannot be any gain. So the last classification is based on number of people involved in number of people exposed to the risk. So it is classified as fundamental risk and particular risk. In a particular risk, one or two few people are involved in the event, like a two-wheeler accident, right? Like a car accident. It's a particular risk. When we say fundamental risk, large number of people are involved in the risk event, like an earthquake, like flood. So that is fundamental risk. So this is how risks are classified, and based on this, fundamental risk and particular risks both can be insured. Pure risks can be insured. Static risks can be insured. Financial risk can be insured. Catastrophic risks can be insured. Right? So this is how we identify and classify the risks. Of all the risks as we have classified, the pure risks are predominantly important as far as insurance domain is concerned. So let's see different types of pure risks. You have chemical risks like a fire, explosion. They are caused by chemical means. Nature causes certain perils and risks like flood, you have earthquake, you have cyclone. All these things are act of God perils, right? They are all pure risks. And social conditions cause certain risks like a riot. When there is a riot, there is a possibility of loss because the rioters, they may set fire to property, they may loot shops, and then they may burn certain cars and two-wheelers. A lot of loss is expected during a riot. So that's also pure risk. Fraud is also pure risk. In a bank, a particular employee may indulge fraud and cause a lot of trouble and a great deal of loss to the bank. That's also a pure risk. Like theft, burglary, this is also pure risk. But technical risks, pure risks, like machinery breakdown. In an industry, when the machinery breaks down, there is a loss to the machinery and also loss to production because of this machinery breakdown. So that's a pure risk. It will lead to loss of profit sometimes. Okay. Now, among pure risks, another important aspect is personal loss. Okay. Personal risk is like individual death, disability, ill health. These are all pure risks. So all these pure risks are insurable. See, when we are identifying risks, another important parameter is the hazard. Now, what is hazard? Hazard is a condition that increases the chances of loss. Right? So let's understand different types of hazard. Simply, hazard is a condition that increases the chances of loss. Does not mean anything unless we understand actually what type of hazards we can expect in real life. Right? The hazards can be classified as physical hazard, moral hazard, and moral hazard. These are three types of hazard. What are the physical hazard? Physical hazard is a condition. Let's say there is a manhole on the drain and you don't have cover on the manhole. It's open. People keep watching it every day. They just walk over that. Right? It's a hazard. It's a risk. Let's say it rains. The manhole is submerged in few inches of water. There is a 1 foot deep water. A stranger to the locality comes. He doesn't know that there is a manhole without cover. It's a risk. The fair chances for that person to fall into the drain. So not having cover on the manhole is a hazard. It is increasing the chances of loss. Right? Similarly, in a factory, you don't have walkway, you don't have parapet, proper railings you don't have. So what happens? In a hurry, a workman may fall down from the rail platform. From a height he may fall down and he may get injured. So it's not having proper railing to walkways is a hazard. Right? Suppose you are driving a two-wheeler. You are not wearing a helmet. It's a hazard. You are not wearing a helmet will increase the chance of loss. So these are all physical hazards. There can be umpteen number of hazardous conditions that will increase the loss. Right? And what is moral hazard? Moral hazard is the possibility of a person indulging in fraud. So for example, you have employed a person and you have given him the responsibility of your cash. He is a cashier. Suppose he is having too many debts. He is under severe pressure from his people who lent him money. Right? There is a possibility that he will indulge in fraud to come out of that pressure. That's a hazard. A person who is highly indebted is a moral hazard. He has a more possibility of moral hazard when you give him the responsibility of cash. Right? Then what is moral hazard? Moral hazard is something to do with your negligence, thinking of lack of vulnerability. In a way, let's say you have insurance, life insurance. Now thinking that, okay, I have life insurance, I have no problem, you cannot indulge in rash driving. Right? You have your property is insured, your factory is insured for fire insurance. Now you cannot do irresponsible things in the factory, storing all explosives left and right without thinking that anyway I am insured, so I don't have to bother. That is not permitted. This is moral hazard. The understanding is that your behavior should be the same way as though you have not taken insurance, even if you have insurance. This is what is expected of the person who has taken insurance. He has to behave as though he did not take any insurance for his property. This is moral hazard. If they behave in a different manner, cause loss, it's a loss to the insurance company, it is called moral hazard. So far what we have seen is the risk identification part of risk management. The next step in risk management is risk measurement. Okay? The risk measurement addresses the question, how frequently may the loss occur? That's number one. It also addresses, if the loss occurs, how severe will it be? This is the second part. The third part is, what will be the possible maximum loss from single occurrence? These three issues are addressed in the course of risk measurement. Now we have to understand risk identification and risk measurement are extensive activities requiring past experience and statistical analysis, mathematical modeling. All these things are involved in risk measurement and risk identification. Okay, but they are not within the scope of our discussion. All we are required to remember is risk measurement involves understanding how frequently may the loss occur. That's number one. Number two, if the loss occurs, how severe it will be. And number three, what will be the possible maximum loss from a single occurrence. This is called PML. This is very, very important for the underwriter to take a decision on underwriting the risk, knowing the possible maximum loss.